I just got paid $299 this week from one single stock. And here's the mad bit. The market was basically flat all week. I didn't need ZETA to moon. I didn't need SOFI to recover. I didn't need to guess the perfect direction of either stocks. I sold options on a stock that I already wanted to own. I managed the trade when the opportunity appeared, and I walked away with almost $300 in premium. The covered calls made $205 in the end. The cash secured puts made $94. The puts, they expired worthless. And the covered calls, well, I ended up buying them back early because ZETA dipped Friday morning. Why? Because earnings had already sent the stock over $20 overnight, and I didn't want the late Friday pump taking away my income shares. So, would it have been the end of the world? No. That's the whole point of the wheel strategy. If my shares get called away, I take the profit. Then Monday, I sell cash secured puts and try to get paid to buy them back at a cheaper price again. Round and round it goes. But this week, I got paid and I kept the shares. That means Monday, I get to do it all again. And the $94 put trade only needed around $3,300 of capital sitting in that account. That is why I started this series, because once you understand this, investing stops feeling like you're just waiting around for stock prices to go up or down. You start building an income machine to fund your ISA. And if you're watching this from the US, same principle. Your Roth IRA, different wrapper, same idea. The idea is trading funds your investing. Quick one before we get into the numbers. If you're new here, feel free to subscribe for Market Mondays and Funded Fridays. Mondays, I'm opening the trades. Fridays, I show you what actually happened. And if you're thinking about Robinhood UK, my referral link is in the description down below. And hey, we both get free shares if you do, so we all win. Most traders lose money. I'm one of them sometimes. I'm not your financial advisor and this isn't advice. We learn the how here, but the why is always yours to decide. Capital is at risk? Right. ZETA. This is Funded Fridays, episode 1. The whole point of the series is very simple. Can I use options income to help fund my stocks and shares ISA? Not theory, no screenshots from somebody else, actual trades, real premium based on my actual decisions. Every Monday, I'll show the setup. Every Friday, I'll show the result. Market Monday is the plan. Funded Fridays is the proof. And this week was all about ZETA. No SOFI trades this week because if you watch Market Monday, you'll know I stayed away from SOFI because of the volatility that promised this week. And that turned out to be the right call because the day after earnings, we all know what happened to SOFI. It tanked by more than 15%. So this isn't about forcing trades. Sometimes the best trade is the one that you didn't place. So this week, I focused on ZETA only. The actual trades I'll get to in a second, but quick context on the week because this is exactly why I didn't force anything. You had Powell held rates on Wednesday, which we expected, but we could have got some dramatic goodbye mic drop moment from him. We didn't, but it could have been possible, so we don't like to gamble. The wider market stayed strong. SPY pushed into all-time high territory. SOFI reported earnings as well, and this is why I stayed away from it on Monday. Personally, I thought the earnings were fine, but the market didn't like the guidance. Management held guidance steady because they couldn't properly account for the future rate cuts. And to me, that's smart management. Don't overpromise just to keep Wall Street happy for one quarter. But from the options point of view, that was exactly the kind of volatility that I wanted to avoid. SOFI dropped around 15% after earnings, so we were completely right not to play it, as we've already said. And then ZETA came in and absolutely smashed expectations. Strong earnings, a strong plan, a proper growth story over the coming quarters and years. So this week was simple. Avoid SOFI volatility, focus on ZETA, get paid. Manage the positions. This week there were two sides to the income story. First off, we've got Tastytrade. That's where I hold my 500 shares of ZETA. These are my income generating shares. I sell covered calls against them to generate weekly premium. Second, my Robinhood GIA. This is the general investing account I set up specifically for this series. That account is there to sell cash secured puts. The idea is simple. If the puts expire worthless, I get to keep the premium. If I get assigned, then I own the shares. But then here's the magic part. When you own the shares, you go and sell covered calls against those shares and you keep the wheel turning. Same principle as being a landlord. You rent those shares out to bring the income in. The goal is not to gamble. The goal is to get paid for decisions that I was happy with anyway. Here we go. Let's start with the covered calls. These were sold against my 500 ZETA shares on Tastytrade. As you can see on the screen, we sold 5 contracts for the 1st of May and we got paid $47 at the $20 strike. That brought in $235 gross. Then Friday morning, we bought those back when the dip happened, which meant that we walked away with a total of $205 collected on the call side. And this is why managing positions matters. ZETA had earnings on Thursday and the numbers were strong. Overnight, the market pushed the stock above $20. That matters because my covered calls were sitting around that area. So Friday morning when ZETA dipped, I had a choice. Do I leave the calls open and risk a late Friday pump and those shares getting called away and I would then lose my income shares? Or do I take the opportunity to buy them back, lock in the majority of the profit and keep the shares to do it all again next week? Well, I chose to exit. Not because I was scared, because the trade had already done its job. I could take roughly 90% of the premium, protect the shares and set myself up to sell calls again next Monday. That is the lesson. You don't have to hold everything to expiry just because you can. If the market offers you a good exit and you're making money, take the win. And this is where people get a little bit confused. People hear my shares get called away and think it means disaster. It doesn't. If my ZETA shares had been called away, I would have kept the premium and sold shares at a profit. That's not exactly tragedy, is it? Then on Monday, I could sell cash secured puts with the collateral that I've received back and try to get paid to buy the shares again at an even cheaper price. That's how the wheel works. Cash secured puts, shares are signed. Covered calls, shares get called away. Back to cash secured puts. It's boring and it's repeatable. Boring plus repeatable is exactly what I want here. But this week, I got the best of both versions. I kept most of the core premium and I got to keep the shares as well. And now the Robinhood GIA side, General Investing Account. This is a part I think a lot of people will find interesting. On the Robinhood GIA side, I sold 2 ZETA 16.50 cash secured puts. $16.50 is what I'm promising that I'll buy them for if it drops to that price. That brought in $94 of premium. And as you can see on the screen, by Friday, those contracts had collapsed down to nearly zero, with the position showing around 90 of profit, roughly 97%. That is exactly what you want when you sell cash secure puts. Time passes, the stock stays above your strike price, the auction loses value, and you keep the premium. No assignment, no drama. Just $94 collected for having the cash ready to buy a stock I already wanted to own. And the capital needed for that trade was roughly $3,300. That is the bit I want people to understand. You don't need a £1 million portfolio to start learning this. You need the right stock, the right risk management, and the right account setup, and the discipline not to force stupid trades. The $94 is not life-changing on its own, but weekly income that keeps feeding an ISA, that starts to become interesting. So, our totals for the week: $205 collected for the covered calls, $94 collected from cash secure puts, $299 collected from ZETA. And this is where the options bridge system comes in. The plan is to use that premium to buy more shares of ZETA inside my stocks and shares ISA. That is the whole pipeline. UK viewers, that's your ISA. US viewers, that's your Roth IRA. Same principle, different wrapper. Options income outside the wrapper, long-term holdings inside the wrapper. Trading, funds, you're investing. That is the middle ground, not day trading, not passive waiting. A system where income feeds ownership. The biggest lesson this week is simple. Exit when the opportunity appears, but only if the trade is already making money. That's the rule for me. I don't want to gamble. I don't want to chase things. I don't want to roll rubbish trades just to pretend I was right. I want to get paid. This week, ZETA gave me the chance to take most of the covered call profit and keep my shares, so I took it. Could ZETA have stayed below the strike all day and expired safely anyway? Yes, and it did. Could it have pumped late Friday afternoon to take my shares? Also yes, that's the point. You don't need to squeeze every last dollar out of the trade. Sometimes the professional move is taking the boring win. And if you're watching this thinking, it's alright for you, Lawsy, you got 500 shares. Fair one. But look at the cash secure put side. Around $3,300 of capital generated $94 this week alone. Now let's put that into some perspective. If you manage something similar consistently over a year, $94 times 52 weeks of the year is $4,888. That's an extra $4,888 you've generated just for yourself. That starts looking less like random investing gains and more like a proper side hustle. And remember, that's before even talking about compounding or reinvesting the premium into more shares. That's not me saying you should copy the trade. Please don't. Everybody needs to have their own conviction. You cannot borrow conviction. Once you understand how premium works, you start seeing investing differently. You're no longer just waiting for stock prices to go up. You can get paid while you wait, but only if you understand the risks, only if you want to own the stock, and only if you can handle assignment without the panic. And finally from me, if you did miss Monday's episode, go and watch that next. That was the setup for this one. This is the result. Monday, I opened the ZETA trades live. Today, I showed you how they paid out. That is how this series is going to work. Market Monday is the plan. Funded Fridays is the proof. If you want the deeper reason why I'm so focused on ZETA, I'll also link my full ZETA deep dive, where I explain why I think this company is one of the most interesting AI marketing businesses in the market. That one will help explain why I'm happy using ZETA as the stock behind this strategy. Because remember, the rule is simple. Only sell options on stocks you actually want to own. Here at Options Brit, we learn the how so we can afford the why. I'll see you on the next one. Bye for now.